Thank you very much for letting me present my paper with Victor Orestes, who's my classmate at MIT, and Thiago Silva, who's at the Central Bank of Brazil. So the title of my paper is Volatility and Underinsurance in Economies with Limited Pledgeability, Evidence from the Frost Shock. The motivation here is that underinsurance is prevalent in many settings where you have financially constrained households and small firms. And in many of these settings, insurance premiums are subsidized below actuarially fair, meaning that by purchasing insurance, a firm or household gets money on expectation. In our setting, we look at crop insurance specifically for coffee farmers in Brazil, but the same intuition applies to many other environmental settings, for instance, flood insurance or wildfire insurance, as well as other settings outside of environment. And typically, when you look at why insurance take-up tends to be quite low, you have a lot of behavioral explanations, and we're not denying that there's probably a behavioral story here, but we think that part of the reason why there's underinsurance are financial frictions that we made clear in the paper, generated from limited commitment and limited pledgeability of your future income or your assets as collateral, as well as repeated net worth shocks. And first, I'll present a model, and then I'll present empirics that try to answer what the general equilibrium consequences are for underinsurance, focusing on the channel through financial markets. So the research question here is, in response to an unexpected net worth shock, how does the interaction of insurance and financial constraints affect firms' subsequent demand for hedging and investment? And our contribution here is first with a model to show that, again, this limited commitment and pledgeability constraint generate differential responses to the shock magnitude by insurance status, and explain why, in response to a net worth shock, firms that had not yet been insured disproportionately decide not to purchase insurance in the subsequent period. And then in our empirics, we show that in response to a one-time shock in Brazil, the uninsured farmers deleverage, so they decrease their debt load. They also get some forbearance, extending the maturity of their debt, and then they invest less subsequently, and they purchase insurance at a lower rate. And then there are some policy implications that I can describe later. So I'm not going to go through the full literature review, but we do relate to this macro finance literature on the causes and consequences of underinsurance, thinking about maybe exchange rate risk, or generally what can generate spillovers across firms with underinsurance. Here, we're looking at a setting where, because in Brazil, Brazil produces about 40% of the world's coffee, comprises over a third of world coffee exports, a shock here is large enough to affect the global coffee price. And this also affects the distribution of farmer wealth. And so we extend the model from Rapini and Viswanathan to show how the same mechanism of limited pledgeability can generate effects across the distribution of farmers. We also relate to this literature on credit and insurance, and specifically, this literature kind of focuses on the extent to which credit and insurance are substitutes versus complements. Here, we can show how they behave as complements due to these financial constraints. And then finally, in our empirics, we think that what distinguishes our setting here are detailed payment and credit data, both for farmers as kind of businesses, as well as their borrowing on their personal account, that allows us to get a much richer picture of how farmers respond to the shock. Okay, so for the theory of what I have in the draft on my website is a partial equilibrium framework where risk-averse farmers are subject to shocks. They can write contracts with these financial intermediaries, and then there is an equivalence between this constrained optimal contract, where the constraints arise from lenders' participation and incentive compatibility by the farmers, because they cannot commit to kind of state contingent repayment of debt in some state of the world where they would actually rather run away with their output or their assets. With this one period state contingent savings and non-state contingent debt. And so that's where you have incomplete markets. And then today, what I'll actually show you is an extension where we have a general equilibrium feedback through the coffee price, and then the debt limit that farmers face, which is basically how much they can borrow or how much they can have borrowed at any point in time, depends both on this aggregate state. So in the empirical setting, it's going to be whether you have a frost or not, as well as the idiosyncratic state. So whether a farmer had a worse magnitude or not so bad magnitude shock. We don't yet have any actual estimation results using simulated method in a moment, but that is the next step here. And then stepping back a bit, kind of the three main reasons why we have a model at all in this paper are because first, we want to explain this underinsurance channel, and we think that this is the right kind of macro financial framework to do so. Second, what we want to do is this decomposition of the kind of empirically observed underinsurance into how much is due to this set of constraints that we have observed versus perhaps some behavioral or other motives. And third, we just want to eventually be able to do this kind of decomposition of surplus counterfactuals as to if you were to have some policy that were to make it easier to pledge your collateral or to increase kind of the kind of value of land, what would change in terms of the distribution outcomes in response to shocks. But those two of the three motivations of the model are not yet ready to show. Okay, so now I'm going to go into the model. So like I described before, you have risk-averse farmers that are maximizing expected discounted utility. For now, we just have a very simple production function where farmers' output depends on their capital stock. So here you can think about that jointly as the land and the coffee plants on the land. And then alpha is less than 1, so there's diminishing returns. And then the capital stock that you have in period T depends on this shock theta from what you inherit from the previous period, which is how much capital you had plus how much you invest. And then theta also embeds discounting. It's state contingent, and farmers can run away with some fraction of their future, the next period sales, and farmers can also not be excluded from the credit market. Okay, and so the problem here with the optimal contract is you have state contingent consumption transfers that you can just think of as a general way to model debt as well as capital stock that satisfy the lender participation constraint. And so these transfers T are specified such that that's how much revenue the lender gets from the farmer. So the lender needs to make, non-negative profits. And then the farmer's incentive constraint is basically not to deviate and default on the contract. And so we show in the paper, and we'll of course not show you the proof today, that this kind of very high dimensional problem is equivalent to a framework where you only focus on the sequential budget constraint as well as a debt limit. And in particular, this debt limit is not state contingent. So the total amount of debt that a farmer can have at any point in time depends on their next period sales that could be affected by the shock. So that's the pledgeability, as well as insurance. And this insurance are these state contingent payments where you pay this premium upfront at the beginning of the growing season. And then if you had purchased insurance and you get a negative shock, then you get a payout. And if you have a good state of the world, then you don't get any payout. And so that's how insurance can directly kind of alleviate the tightness of the borrowing constraint. And that's also how credit and insurance are not substitutes in this setting. And then we just simply assume that there is a constant elasticity of demand for coffee traded on the global market. We assume that the rest of the world's coffee supply is unaffected. We also assume that the interest rate is exogenous and constant. In our setting, most of the agricultural lending is done through a public bank at rates that are more or less set by the government and below counterfactual market rates. And so we believe that this is reasonable in our setting, and it makes the kind of model relatively easier to solve. And then to motivate the event studies, yes?
So just fix ideas there. How far should we think about the intuition as mirroring the kind of Casaburi and Willis across the line?
Yeah, exactly. So the Casaburi and Willis paper says that, well, if you have a setting where you can allow farmers to basically pay the insurance premium at harvest because you can monitor and make sure that they don't, run off with their crops in the good state of the world, and you can just basically deduct the insurance premiums from their harvest in the good state of the world, then you have higher insurance take up. And so it's the same intuition here, but here we're taking serious this constraint in that on a larger scale, you can't perfectly monitor how farmers channel their sales. So if you try to implement the Casaburi-Willis contract on a big setting, farmers could, in the good state of the world where they harvest more, just basically sell in a way that you can't observe as the lender or as the insurer. And then they could basically falsify to some extent how like good or bad their state is.
I see. So you're sort of building on the same intuition, but you're accommodating another set of frictions that might be relevant for these.
Exactly. That's a good way to phrase it. Okay, and so here's a numerical exercise simulating from the model to motivate why we run the event studies that we run. And so here we assume that farmers either have a bad state where the capital stock decreases by 70%, or a good state where there's just a depreciation of 5%. The other kind of features here you don't have to worry too much about. And the solution method is Russell-Smith, and so it's endogenous grid. And we're taking this approximation so you don't have to keep track of the infinite dimensional distribution of farmer wealth. And the main takeaway from this figure is that when farmers have relatively low net worth, so just relatively low assets that they can use as collateral, then if they were to receive a negative shock, their capital stock is a lot lower than it would be in a complete market world where they're not hitting their borrowing constraint. And they would prefer to achieve the higher return on capital by basically investing in their production, so investing in their coffee plants, rather than purchasing insurance. And so for low levels of net worth, again, the returns on capital are high enough that they would rather not purchase insurance. And then for these intermediate values of net worth, then you start seeing this kind of upward slope, where now the kind of, if you were to relax their borrowing constraint, they would devote more and more to purchasing insurance because they're already at the level of the capital stock that they want to have. And if you were to extend this graph to the right, so farmers that are not constrained would be fully insured and would also just have the correct level of capital stock that matches the return on capital to the interest rate that they face. And so the corresponding event study here is if you were to have this shock that has different kind of incidents across different farmers, and then you were to have farmer fixed effects and time fixed effects, and here we're focusing on the set of uninsured farmers, then those farmers would reduce their debt load, even though in the aftermath of the shock, those who are more affected have a higher return on capital. And in particular, they invest much less and they just permanently have a lower capital stock. And so this is just kind of simulating from the model to show what happens in response to this frost shock for low net worth farmers who are uninsured. And then I'll later show you empirics that kind of mimic these figures and show that the model seems to at least qualitatively have a good fit. And then the last thing that I'll show you directly from the model is that the persistence, so here this is like quarters of the change in the world coffee price lasts for a long time. And so immediately when the shock occurs, there is say a 12% increase in the world coffee price. In practice, we actually see a larger increase in our setting that the coffee futures increased by about 20% in response to this frost shock in Brazil. And then in our model, we showed that because some of these farmers are permanently producing less, and so kind of global aggregate supply is permanently a bit lower, that you have a long-lasting increase in the price. Okay, so that's enough of the model. Now I'm going to describe the empirical setting. And so here we have unusually severe frost in the winter of 2021 in Brazil. So remember, Brazil in the southern hemisphere, so it lies in the winter. And the elasticity of demand in coffee is quite low. It's quite inelastic. And so you saw a large spike in prices as a result. And so you saw this for the futures prices across a variety of continents. And so again, the shock was in July 2021. So even for the kind of futures prices a year and a half in advance, you saw it increase similarly across maturities. Sorry. And coffee plants are perennial. And so it takes over 3 years for a coffee plant to be mature enough to bear fruit. And then we harvest the seeds to use as coffee. And Brazil, like I described earlier, produces almost 40% of the world's coffee. So the data that we use in our paper, yes?
Is there any particular reason you have to use a large shock rather than any just weather variation affecting different markets? What's the reason for focusing on this particular shock?
Yeah, so the reason why we use a shock that both has an aggregate and an idiosyncratic component is that we think that there are various other shocks, both in agricultural settings and in other general settings, where if you were to just run the event study with an aggregate component, you're losing the aggregate component through fixed effects. And then it's kind of motivating why we apply a model to this framework rather than just running regressions. So it's very much the case that you could have some other settings where it's just idiosyncratic. You can get the coefficients from the event study, and then you can interpret them without the lens of a model. And so basically we're kind of constructing, so we constructed the model with the empirics in mind, but we have in mind a certain subset of empirical shocks where such a model would be useful. Yeah. Okay, so for the data that we use in the paper, it's all accessed through the Central Bank of Brazil. So we have insurance contracts from the kind of public insurance provider in Brazil. So most farmers in Brazil who purchase any insurance purchase the government because it's heavily subsidized. The typical insurance premium subsidy for coffee in Brazil is 30%. We also observe top-off insurance for private contracts, but those are relatively small and pretty heavily selected by the largest farmers. And then beyond the sort of rural credit that is heavily subsidized to agriculture, we observe all other loans that people take. And so sometimes a farmer will borrow through its registered farm, so as like a firm for the rural credit, but they also will borrow on the personal account. And one unique feature of our setting is because we have the kind of personal identifiers linked to the firm identifiers, we can observe the total debt that farmers take. And we also observe the location of the farms, which allows us to get this really granular metric of the magnitude of the shock that they face. We also have data on farm area, expected and realized production to really look at the full heterogeneity across farmers. And then finally, we have payments microdata. So this is bank transfers, but also firm-to-firm payments via something called boletos and instant payments that allow us to see, or at least proxy for farmers' sales as well as purchases of materials at a level that's roughly the same as a 6-digit HS code. So it's fairly granular. Yeah. So yes, what the farmers insure for coffee is the value of the plant. So it's not just the kind of expected production in that period, it's the entire kind of value of the plant. And so the typical insured value, the average is $122,000, where by comparison, farmers' kind of gross income is about $20,000, and the debt load here is about $80,000. So the insured value here is quite high, and it's like the value of the coffee plants, not just the production that you expect.
It's not engaging any of the index stuff.
So yeah, so it is indemnity in the sense that the payouts are agronomists go into the fields and assessing the crops. It's not tied to some rainfall or weather index. Yeah. Okay, and so the first regression that I'll show is regression of credit. And so here we have farmer fixed effects as well as municipality by time fixed effects. And we also have separately the set of fixed effects for the set of insured versus uninsured farmers. And then the coefficients here are basically within the set of uninsured farmers, comparing those who had a more severe frost shock, and then separately within the set of insured farmers, comparing those who had a more severe frost shock. And so you can think about this as basically two separate diff and diff stacked together, and the fixed effect here basically does the stacking. We could also just have run this as separate fixed effects, but we have a bit more power this way. And the takeaway here is for the uninsured farmers, they deleverage. And so this is probably going to look fairly similar to what we had in the model. And it just shows that what we actually observed, which is that in response to, say, a 1 percentage point more severe shock in terms of 1 percentage point of the insured value was destroyed, then you have about also 1% decrease in the debt load of the farmers permanently. But for insured farmers, you get basically a zero effect. And that is, again, comparable to what our model generates. And then one thing that we don't directly feature in the model is the kind of maturity of debt. And so the average maturity here is 7.5 years. But we see that, again, for a 1 percentage point increase in the kind of damage of your insured value for the frost shock, then you would get 0.2 months longer debt maturity. So it's relatively small compared to the baseline maturity, but this does show that there is some forbearance going on. And again, for insured farmers, we don't see any effect with debt maturity. And so kind of the takeaway here is there are various effects here with kind of the impact on credit. And then with payment regressions, we look at farmers' input purchases specifically for product categories that are consistent with what we describe as investment. And so here that's like farmer seeds, as well as kind of machinery that helps them kind of till their fields and help them plant new coffee trees. And here we run two versions, one where we just look at all agricultural inputs and one where we restrict the set of inputs that specifically, again, we associate with investment, and that's what I show you here. And so here the fixed effects are, again, at the farmer by supplier level. So this is bilateral, payment regression, where the farmer is a purchaser and the supplier is selling it to them, as well as the municipality of the farmer by supplier kind of sector code or product code by time fixed effects. And again, the identifying assumption is that conditional on the rich set of fixed effects, whether or not you got a more severe frost shock is as good as random. But again, we have separate kind of stats, diff and diffs for insured versus uninsured farmers. So we're not making any claim about insurance take up being random. And indeed, it is very much non-random. It's very much selected. And that's part of the point that we have in the model. And so now here I've just stacked the two coefficients. So you see that uninsured farmers purchase fewer of these kind of investment type goods, especially in the next growing season. So this is at the quarter level. And so this corresponds to kind of the subsequent growing season, while those farmers who had previously been insured actually increased their purchases a bit. And you would expect them to increase their purchases simply because they used part of the insurance claim, like I showed you in that debt limit regression, to make up for the fact that their borrowing constraint has otherwise.
What's in the investment measure here?
So again, we look at purchases of specific agricultural inputs like seeds, as well as the coffee like plant saplings, as well as machinery. So there's a specific 7-digit CNI code, which is again similar to 6-digit HGS code. That's like the machinery that farmers use to kind of like till their soil.
And can you track whether that led to bigger outputs for insured insurance?
For insurance, for insured farmers. So that's a good question. So you're basically asking, why don't we look at sales here for insured? So subsequent period sales, that's a good question. We haven't looked at that, but we can look at that. And then I also have some additional results that I won't go into with insurance. And so we see that insurance take up, as well as intensive margin of the coverage level, both decrease for the affected uninsured coffee farmers. But then for kind of unaffected farmers nearby to the affected farmers, we see an increase in insurance take up. So that's probably behavioral. And then we see that for the annual crop farmers, there are very muted, basically zero effects on insurance. We also don't see any effects on the interest rate nor the default rate, but at least for the interest rate, this is again by design in our setting in Brazil. And then we also look at other forms of hedging besides insurance, for instance, futures contracts, because coffee is a globally traded commodity. And we see that at baseline, very few farmers enter any sort of like derivatives, say traded on like the Chicago exchange. And we also don't have the power to estimate any change because it's basically zero to begin with and zero afterwards. And so there are two kind of high-level policy implications of our setting. So one is emergency credit lines, which are popular in many settings in response to kind of shocks, may not be effective when the financial intermediaries who are administering these credit lines are themselves unconstrained. And so this is analogous to what we saw with the payment, the Paycheck Protection Program, the PPP in the US in response to COVID. And then there is a kind of another analogous sort of policy intervention, which is, well, what happens when the government just gives transfers to the farmers? That indeed can explain some uninsurance. Currently, we don't have a good way to explain that in our framework because that's a moral hazard story. And we have thought about, well, why don't we introduce a moral hazard constraint as well, and then basically have a horse race between this pledgeability constraint and moral hazard. But we're currently not sure how we would solve the model to feature all those constraints. But we very much acknowledge that while emergency credit lines are a common response, perhaps the government giving bailouts are kind of the FEMA in the US, the Federal Emergency Management Agency, just rebuilding and compensating everyone who is affected, whether they were insured or not, maybe an even more relevant intervention for policymakers. And then another kind of policy implication of our setting is that if you were to increase the effective pledgeability of farmers, you would alleviate this set of constraints that cause the differential outcomes that we described. And there's ways to use technology, say like granular satellite imagery, to verify farmers' crop conditions that make it easier for farmers to pledge their harvest lender. So this is exactly my answer to Claire's question, which is if we can move closer to a world in which the Casselberry and Willis intervention in a set of villages in Kenya could actually be feasible at a large scale, then you could alleviate some of these issues. And you could also try to increase the effective value of the land that you pledge as collateral. Because one big problem in Brazil is that once you pledge your land as collateral to one lender, even if you're not borrowing up to the full value of your land, your existing lender has monopoly power over you because no other lender is going to want to borrow with the remaining value of the land because of both like issues in the courts, as well as without some technology, say like tokenization of the assets, the land is kind of an indivisible asset for a legal context. And so to conclude, so we show both theoretically and empirically that insurance take-up matters for how farmers are affected by a shock. We also argue that because of the structure of insurance, where you have limited commitment, you need to pay for the insurance premium upfront, then in response to kind of repeated negative net worth shocks like you have in some agricultural and other environmental settings, you can generate underinsurance through financial constraints, not necessarily through a behavioral explanation. All right, thank you.